Hello and welcome to our modern money journey. Just a brief reminder that I am not a licensed professional. This is not investment advice. This is for entertainment purposes only. Hi everyone and welcome to the first episode of Build a Portfolio. In this series, we're going to take a look at the markets. So we'll just look at cryptocurrency markets, the commodities markets, and the equities markets, and just see how they're all doing broadly. And then we will deposit $100 into our Webull account and make a purchase monthly. If you haven't yet signed up for Webull, there's a link in the description below. And if you deposit $100, you'll get 2 free stocks. So let's go over some of the basics. So what is a portfolio? Well, a portfolio is simply a collection of all of your investments. But like I said, in this series we're going to focus on mainly equities. Now let's discuss some different strategies that we'll have to go over to decide how we're going to manage our portfolio and what types of stocks we'll invest in. So the first types of strategies we're going to have to discuss is management style strategies. Is our portfolio going to be passive or active? So a passively managed portfolio is essentially where we're seeking to make market returns. We can invest in various indexes that just follow whatever the market is doing. We can invest in NASDAQ indexes, S&P 500 indexes, and just get whatever the market's doing. The other strategy is active, where you yourself or I myself actively manage my portfolio. You can also pay like a fund manager to manage your portfolio for you, but in this series I'm going to be doing it myself. The whole goal of an actively managed portfolio is to try and beat the market. You are trying to pick the absolute best stocks that you can so that you get a better return than the overall average market does. This is simply not doable for all investors. That's why most people, especially if you're not an accredited investor or someone who's very knowledgeable on the stock market, should just stick with index investing. That's what's best for most people. This may surprise you, but even a lot of actively managed funds by professionals do not outpace the market. You actually get better returns just parking your money in an index fund, leaving it sit there, and getting average market returns. The next type of strategy to discuss is asset allocation strategies. That's when you decide or figure out how much of your portfolio do you want to be allocated to different types of assets. Say you want 50% bonds, 30% equities, and so on. In this series, like I said, we're going to be 100% focusing on equities. We'll do other videos where we focus on making purchases in other markets. The next group of strategies that we need to discuss are investing strategies. We'll put up a list here so that you can follow along as we discuss them. The first one we'll talk about is value investing. Value investing is where you are trying to buy an undervalued or decently valued company. So this is when the market cap, or what investors are paying for the company, the price of the stock, is lower than or equal to, or roughly equal to, what the fundamentals of the company seem to suggest it should be valued as. Contrarian investing is a go against the herd type mentality of investing. This is where if you believe all the investors are not looking at a company because some recent bad news or something of that sort, then you park your money in there and hoping that everyone else is wrong and you are the contrarian. Like I said, this is a go against the herd type investing technique or strategy. Next, we'll talk about growth stock investing. Growth investing is when you invest in companies that have above average earnings, regardless of what the price is of that stock currently. So you don't care about what their market cap is, you don't care about what their price is, you are looking at what their earnings are, and you want them to be above average earnings. Lastly is momentum investing, and this is when you look for companies that have been making big moves lately in their price. That's mostly used for trading, so we'll not be using that type of strategy in our Build a Portfolio series. The last type of strategies that I'd like to mention real quick are risk management strategies. Perhaps most common is diversification strategies, where you make sure that you don't have any more than a few percent of your holdings in one specific company or asset. But there's other types of risk management strategies, such as value at risk or maximum drawdown. But that's a little bit advanced for this video. There are other more advanced topics in modern portfolio theory, such as the efficient frontier, for example, that we won't cover in this video, but we may cover in a later video of this series or in a separate educational adventure. So now that we've covered these basic strategies that are used for developing your style of investing, you need to decide which ones work for you. Which strategies work for your beliefs, your goals, and your risk tolerance. This series is going to be about what I'm doing. It's going to be about me building my portfolio. I'm going to be building this portfolio using a combination of the various techniques that we talked about briefly, and I'm going to be actively managing it, meaning that I'm going to be the one running the portfolio. I'll be using a combination of 3 different factors to help me decide which stocks I will select to include in my portfolio. These 3 different factors are 1, my investment thesis, 2, some technical analysis, and 3, some fundamental analysis. Now let's discuss my investing thesis. It is my belief that I have come to through my observations of the world around me that our society is becoming increasingly reliant on technology. Therefore, technology and communications and other tech-related companies will play a huge part in our portfolio. However, we also need to be aware that many companies in the tech sector are overvalued at this time. So we're going to have to be selective of which companies that we purchase. It's another aspect of my investment thesis that I've made through my observations of the world around me, that the medical field and medical related industries will continue to be a sector that investors can benefit and profit from while helping the world be a better place. So with that in mind, the medical field will also play a big part in building our portfolio as well. The last aspect of my investing thesis that I'd like to cover real quick is that currently it's my belief that commodities, or for the most part, most commodities, and land or real estate are undervalued in comparison to where they could or should be in the near future. So with that all being said, you need to decide what you want to do for your portfolio and how you want to manage it. And let's get started. Alright, so whenever we do these Build a Portfolio episodes, we will take a look at some of the other markets other than just the equities markets, just so that we can gain broader perspective on how all the markets are doing, just so that we can maybe gain some insight into where our money might also be put to use other than just the equities markets. So if you've been following the channel, or if you know me personally, you know that I'm a big fan of the cryptocurrency markets. So let's take a look at those and see how they're doing. So today, it looks like there's a mixture of red and green across the board, with some of the smaller plays more in the green, where the big plays like Bitcoin and Ethereum and Ripple are, just a little bit in the red, ranging from, a fraction of a percent to almost a percent down. But overall, not a bad day. Let's take a look at Bitcoin and just show how it's been doing. To actually switch over to the trading view charts, I like those a little bit better. So as we can see, over the last couple months, Bitcoin has been trending upwards, and we've just been sort of hanging out in this mid to high 11,000 range for the last, couple weeks, and hopefully we'll be breaking out above this 12,000, the high 11,000 to 12,000 range here soon, and keep climbing. Alright, let's go on to take a look at gold. So gold over the last month has been trending upwards. We're seeing a little bit of a pullback from this peak here. Let's throw on the 1 year chart. We can see that it's been climbing all year, other than this little dip. And then, this is the peak that we saw recently that we're pulling back from. And if we take a look at the all-time chart, we can see that that peak is actually a new all-time high for gold. So if you were one of the people that have been buying in down here over the last couple of years, you'll be seeing some nice returns from that. So if we take a look at silver, here on silver's all-time chart, we can see it's pretty similar to gold, except for silver tends to lag gold. So we can see silver hasn't yet put in a new all-time high. I'm hoping and expecting it to do that here over the next several months or so. But like I said, silver tends to lag gold. So gold just recently put in a new all-time high, so it might be a little while before silver does, but it's been climbing. We can see that better by looking at the gold to silver ratio here. So the gold to silver ratio is the price of gold divided by the price of silver. So anytime that this gets real high, that means that the price of gold is much higher than the price of silver than it typically is. So we can see that since silver's been, if we go here to the 3 months chart, as silver's really started to spike up recently, the gold to silver ratio has started to come back down. But if we go back out to its all-time high, it's still got a ways till it comes back down to its average just over like the last 20 years. So that means that silver still has a lot of room to run in comparison to gold in order for it to, hit this average. Alright, so let's take a look at the equities markets, starting off by looking at the S&P 500. So this is the S&P 500 over the last couple years, and we can see it's been quite the ride. We've been generally trending upwards, but we've had quite a few hurdles along that way. And if we zoom out to a longer time horizon, we can see that we're actually at quite a high level of valuations. So this back here was the 07 housing bubble, and then this back here was the dot-com bubble, and you can see that the S&P 500 index is about twice or over twice the valuations that it was during both of those bubbles. So moving on from that, let's take a look at the Dow Jones Industrial Average. So you can see that it's been trending up over the last couple years as well, with a few hurdles as well, but not quite as pronounced. And if we zoom out, we can gain some more perspective on it. So here, was the housing bubble and the dot-com bubble, and we can see that the Dow Jones Industrial Average is also over twice the valuations that it was in the two most recent bubbles in history. Lastly, let's take a look at the NASDAQ Composite Index. So recently we can see it's been trending upwards as well, same hurdles. And zooming out, we can see that it didn't reach quite as high valuations during the housing bubble, as the NASDAQ is tech heavy. It's a lot of tech companies in the NASDAQ trade on the NASDAQ exchange and thus are in the NASDAQ index. And that's why it reached such high valuations back during the dot-com bubble. So, but we can still see that we are still over double the valuations that we were back during the dot-com bubble. This is why I say we need to be selective about which companies we put our money in. It's not definite, but from the data it seems to indicate that it's a possibility that we are in a bubble, that the stock market and the equities market is in a bubble. So we don't want to pay more for a company than we should. We want to be smart about which companies we buy and how much we pay for them. So let's use some tools that are available to us through Yahoo Finance that can help us try and find companies that aren't overvalued so that we're not paying too much for them. So here we can come to screeners and come to equity screener, because we're going to be looking for a stock. Then we're going to want to be investing in the United States. For this episode, we're going to go with a larger company, so we're going to go mid-cap, large-cap, and mega-cap companies. Since we're only putting in $100 a day, we're going to do less than $100 for the price. Let's add some sectors that align with our investing thesis. So we'll do basic materials, we'll skip over financial services, do consumer defensive, utilities, energy, technology. We'll skip over consumer cyclical, we'll skip over real estate for now. We'll do healthcare, and we'll come back and look at real estate in another episode. We'll click healthcare, communication services, and industrials. Then we want to add some more filters. So let's add our price to earnings. Let's add our market cap's already checked. Let's make sure we're going to get paid some dividend. And then let's get return on assets, gross profit margin, and return on equity. So let's close those. Let's do a price to earnings of, we'll go less than 15. There are definitely companies that have PE ratio higher than 15 that could be a good buy, but just for this episode, we'll go with less than 15. We won't go in these higher dividend yields because normally that just means that companies can't sustain that high dividend yield and that they're paying too much of their income out as dividends. Oh, but we want this price to earnings ratio, to be less than 15. Now this return on assets, we want this to be greater than, and we want it to be positive, and we'll just do 1%. We want our gross profit margin to be greater than 1%, and we want our return on equity to be greater than 1%. So this means that these will all be positive. So let's find these stocks. So we have about 240 results. And right away I can see that we have some big name companies jumping out at us like Verizon and Intel. Let's scroll down, another big name company like Exelon. Let's go to 100 rows so that we can see more of these companies. Keep scrolling through. There's Kroger, Tyson Foods, a few others. Okay, let's scroll back to the top and let me point something out, which is these are ranked in by market cap. So the bigger companies that are more valuable are near the top. So I'm going to actually click on Intel so that we can take a look at that. It's jumping out at me that it's near the top, so it's got a big market cap, and it's also jumping out at me that it's got a pretty low PE ratio. So let's click it, and let's take a look at Intel Corporation. So its price is a little below $50. It's got a market cap of a little above 200 billion. Let's take a look at its chart. So let's scroll out a little bit. Let's get 5 years. Alright, so looking at its 5-year chart, we can see that its price is down from its recent highs of up here in the $60 range. Now it's down here in this $50 range, and if we look at its price over this past, if you notice how it keeps seeming to bounce off this price range. So its price comes up and then bounces, bounces, bounces. This price range in here, which we'll go over this more in an educational adventure later on, but this price range is what's known as support. So we'll talk about that in the technical analysis educational video. But this price range, which is support, has been acting as support. So the price comes down, bounces off of it, and is supported by this price range. You can see it's been supported once, twice, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times, and is now back down in this range a 9th time. And it looks like over these last couple times it's keeps climbing up just a little bit more, which is very bullish. So we are at a nice support price. We are down from recent highs. Let's take a look at its all-time. Wow, we're down big from all-time highs. This would have been during the dot-com bubble. But going back to that 5-year chart, so yeah, looking at these recent prices, it looks like it's a relatively good buy. So let's take a look at some of its statistics. Alright, so here's its profit margin and operating margin, both about 30%, which is good. Return on assets and return on equity, both double-digit positives, which is good. Let's take a look at its balance sheet. Sitting on about $25 billion in cash, only about $38 billion in debt. So with their cash flow and that amount of cash, they could eat down this debt pretty quickly. Let's take a look at their dividend data. You can see that they're paying out a decent 2.7% dividend, and their payout ratio is not high at all. So that means their dividend is pretty safe. They're not paying out too much of their income as dividend. So overall, Intel looks pretty solid to me. But let's take a look at Intel's biggest competitor, AMD. So Advanced Micro Devices, one of their more hyped competitors, is at about half of the market cap of Intel. And their PE ratio, this is jumping out at me. This is absurdly high. But let's take a look at their chart. If we take a look at their 5-year chart here, we can see that they've just been climbing like crazy. Let's look at their max. Yeah, they are what appears to be at an all-time high, even in comparison to the housing bubble and dot-com bubble. So let's go back to the 5-year chart. Yeah, so they're about basically at an all-time high. I never recommend buying anything at an all-time high. So let's take a look at some of their fundamentals. So yeah, first thing that's jumping out at me is this large trailing PE, large forward PE. Profit margin and operating margin are both positive and good. That's really good. Both the return on assets and return on equity is really good. Let's take a look at their balance sheet. They're sitting on almost $2 billion in cash, and their total debt is about $1 billion, so they could wipe their debt out pretty quickly, which is great to see. But let's take a look at the dividends. No information, so I'm going to assume that they're not paying out any dividends right now. So after looking at both of these, I'm going to say that Intel looks like a pretty good buy. It looks to be at a good price to buy relative to where it's been over the last couple years. It seems to have a good balance sheet. It seems to be putting its money to work, and its competitor to me seems to be overbought right now. I'd like to also say that I noticed the other day when looking into Intel that I was thinking about how the market was going to be growing for them, and I realized that 4 or 5 years ago I owned one laptop and it had an Intel chip in it, and now I own 3 laptops for my various businesses and work and school, and they all have Intel chips in them. So even if there is more competition for the share of the market, I believe that the market will be growing so rapidly that Intel will continue to be profitable for a long time. So I think they're a great buy, so I'm going to go right ahead and buy right now. Let's put in that purchase. Alright, there we go. Okay, now let's go to our portfolio. So as you can see here, Intel's in our portfolio, and I'm just going to use this time to let you guys know that I actually put that order in Friday right before the close of market, or like an hour before the close of the market, and its price dropped a little bit, so I'm actually down a little bit. I'm down about 0.29%, and I'm not worried about this at all. This is a long-term hold for me. You have to get used to being down at some points, and this is nothing. In all honesty, if Intel went down even more, I would probably just buy more, because I believe they will continue to be profitable and will continue to be around and do well for many years into the future. I also want to take a moment to say that the reason why I only bought one share is because I'm gonna leave the remaining cash in the account so that when we deposit $100 next month, we'll be cash heavy so that we can take advantage of any opportunities that might come our way next month. But with that being said, alright, let's get back to the episode. Alright, thanks for watching the first episode of Build a Portfolio. If you liked the content, please like and subscribe, and please leave a comment down below about which stock you purchased to start building your portfolio. Alright, all you bulls and bears, I'll see you next time.